I'm Kevin Golden, a member of the James Moore manufacturing team and a partner at James Moore. Today, we're joined by Jay Hawkins, who is a senior economist with PNC Bank. Now, while working in and growing your business, it's easy to lose sight of the industry-wide trends, analysis, where it's headed. You may know what's going on in your neck of the woods, but what about manufacturing in other parts, your state, and outside of maybe the state of Florida or whatever state you reside in, all across the U.S.? How does that compare to what you're seeing at your level, at where you are? Well, today, Jay is going to help us focus on the future outlook of manufacturing, both at maybe a macro national level, as well as a little bit more of a local and state level. So, Jay, welcome to the show.
Thank you, Kevin. Happy to be here. Thank you for having me on.
Absolutely. Glad to have you on. Now, Jay, there is a lot in the manufacturing industry we could focus on. I mean, a lot of different sub-segments, trends, and so forth. But, I mean, think about it. There's automation, supply chain, workforce gaps, a lot of different things we hear about from clients and the general industry. But what topics do you see kind of at a high level maybe are most pivotal when looking at the future, the next year or few years of manufacturing?
Well, that's exactly right, Kevin. There are numerous challenges facing U.S. manufacturers, but I would like to focus on one of the more immediate headwinds, which unfortunately is still high interest rates. For some background, the manufacturing sector has contracted in 25 of the past 27 months through January of this year, according to the Institute for Supply Management Manufacturing PMI. Now, the first contraction occurred in November 2022, 8 months after the Federal Reserve began hiking the Fed funds rate in an attempt to lower runaway inflation. Now, in total, the Fed raised the Fed funds rate from a range of 0 to 0.25% to a range of 5.25% to 5.5% over a period of 15 months from March of 2020 to May 2023. March of 2022 to May of 2023. Now, the good news is the manufacturing sector did expand in January, but obviously 1 month doesn't constitute a trend. And the reason I highlight the fact that interest rates are so problematic is because we all know that the manufacturing sector is very interest rate sensitive. And to this day, with interest rates still elevated, it's still having an outsized impact on the manufacturing sector. Now, to reinforce that point, this rapid increase in interest rates restrained growth, as I mentioned, in the interest rate sensitive manufacturing sector, with production dropping 0.6% from March of 2022 to May of 2023. Moreover, looking at a more recent data point, production is down 1% in December 2024 from March of 2022. So manufacturing production is lower than it was nearly 2 years ago. Now, the good news is there is relief on the way. As we all know, the Fed reduced the Fed funds rate by 50 basis points in September of last year, and that was followed up with 2 more 25 basis point cuts last year for a total of 100 basis points of relief, lowering the Fed funds rate to a range of 4.25% to 4.5%. Now, if I was showing you our forecast from last fall, we expected a further easing of 100 basis points in 2025, but stubbornly high inflation, and just to highlight how stubborn it's been, core CPI growth, which excludes the volatile food and energy components, accelerated to 0.4% month on month in January. That was double the 0.2% increase in December, and that pushed the year-on-year growth rate up to 3.3%, which is far above the Fed's 2% objective. Now, to really illustrate how sticky inflation has become, and we knew the last mile to that 2% objective was going to be bumpy. It wasn't going to move in a straight line. It was going to take some time. Nonetheless, that year-on-year growth rate has been range-bound between 3.2% and 3.3% since the middle of last year. So that really speaks to the fact that the progress on inflation has stalled. And the other thing I want to highlight here, so it's not just the fact that inflation is stubbornly high, but there's also the possibility of tariffs by the Trump administration. And that's prompted us to pull back our forecast for just 25 basis point cuts this year. And that'll put the Fed funds rate in the range of 3.75% to 4% by mid-year. Now, in terms of when we're expecting those cuts, as of today, we expect 25 basis points in May and another 25 basis points in July. But that could very well be pushed out depending on two things: what happens with inflation as we get additional readings, and also what happens with the Trump administration in terms of implementing tariffs.
Right.
Nonetheless, I do think that lower interest rates should pave the way for the manufacturing sector to gradually recover over the next 2 years. All of that growth will be limited somewhat by the strength of the US dollar, with other central banks around the globe slashing interest rates by a much greater extent to support weaker economic growth relative to the United States.
Yeah. So it sounds like, just kind of summarize, thank you for that. It sounds like you said, it's gotten better, right? Since when was it, that 2023 timeframe? But there's been a few outstanding factors, new administration and other things, that continued inflation and all that. Maybe, like you said, those last few cuts or those last few points that we're expecting to be lowered, it's going to take some work. Or as I like to say sometimes, in any trend, business or otherwise, sometimes progression is always not linear, right? Or in this case, going down, right? Where it's not always, oh, well, we're just getting lower and lower and lower. It may be little hikes or bumps in the road, but overall, trending the right way. Maybe it takes a longer time frame or whatnot, but it sounds like, to summarize all that, that's kind of what we're saying here, is that we still projected that we're on a positive path, but how quickly we get there, what that actually looks like from, now through the end of the year going into 26, it just has a few factors in there, a few moving parts that may affect how quickly that is or how slow that may be. Is that right?
That's correct. Yeah. And I think the overriding message, to put it in simple terms, is higher for longer. Certainly, when the Fed reduced interest rates by 50 basis points, I think they were concerned. It looked like, if you go back to September of last year, it looked like we were getting a slowdown in the labor market and what the Fed would have liked to have seen. And I think that was the reason for the 50 basis points there. And at that point, they were happy with the progress on inflation. But little did they know we were at the point where that progress was going to install. And to your point, we knew this wasn't going to move lower in a linear fashion. There were going to be some bumps along the way, and we're going to see some increase in inflation from month to month before it settles down towards that Fed's 2% objective.
Sure. Yeah. Well, and you mentioned labor there too. I mean, talk about a hot topic in manufacturing, in any probably industry, but especially manufacturing, is your workforce, right? I mean, so I think we talk with lots of different folks, from different service providers to different manufacturers to different just people in and around associations and so forth. And workforce is usually one of the top three that's going to come up every single time. So, how do you see that, looking from your point of view, from y'all's forecast, kind of looking maybe through the rest of the year and kind of in the near future? For I know obviously it's going to have effect. These all kind of affect one another, but how is that looking? Is that kind of the same? Okay, well, maybe it's getting a little bit better. Maybe there's some hope in there. It's just not going to be linear, or it's not going to be easy, or kind of give us some insight there. What your thoughts are?
Yeah, I think just in general, we are expecting a slowdown in job growth. If you look at the job gains in January, they dipped to 143,000 from over 300,000 per month in the month of December. Now, some of the gains that we saw in November and December were due to the payback from two one-time factors: the Boeing strike that has since been settled, and also the twin hurricanes in Florida, which as you reside in Florida, something that you can identify with. But more specific to what's happening with manufacturing, we know the service sector, all services are local. We know the service sector, consumers have shifted some of their spending to services. And in fact, if you look at the counterpart to the Institute for Supply Management, PMI, on the service side, that's only dipped into a contraction territory 1 or 2 months since they started raising interest rates. So holding up much better. And in fact, what we saw was that about 1.4 million manufacturing jobs were lost during the COVID-19 pandemic. But at that time, the industry was already facing a potential labor crisis. And a study by the Manufacturing Institute projected that 2.1 million there'll be 2.1 million unfilled manufacturing jobs by 2030, resulting from a lack of skilled labor. Now, if you look at the more recent data here, as of December 2024, the level of manufacturing employment in the U.S., it's 1.8% 8% above the pre-pandemic level in February 2020, which sounds encouraging. But when you contrast that with the gain in total non-farm jobs, that was 5.7%. So the manufacturing sector job gains are certainly lagging what's happening with the overall labor market. And this really highlights the difficulty of U.S. manufacturers to find the right candidates to fill those open positions, and also the fact that the manufacturing sector has been battered by these high interest rates, and it's been a relatively weak recovery compared to some other sectors. Now, if you look at the comparable numbers for Florida manufacturing, they're up. For manufacturing jobs are up 4.6% since February of 2020. But again, contrasting that with the increase in total non-farm jobs, it trails that number, which was 7.9%. And also, and probably no surprise here, when you look at whether you're looking at Florida, U.S. manufacturing employment as a share of total employment, U.S. share was 8.1% in December of last year, and that's down sharply from a peak of 38.8% in November of 1943. So certainly we don't have the job. We only have the state data going back to January 1990, so we can't go that far back. But suffice it to say that when you look at a share of the total employment, whether you're looking at the U.S. manufacturing jobs or Florida, it's well down off the peak. Now, the good news is, if you look at a survey from the National Association of Manufacturers, this is their fourth quarter outlook survey, the expected growth rate for full-time employment over the next 12 months is 1.3%, and that's up sharply from 0.3% in the third quarter. So as a result of that, I think it's safe to say the hiring outlook for manufacturers is brighter, certainly, than it was. Now, looking at some other data in that survey, 7 out of 10 manufacturers have less than 5% of jobs unfilled. And on average, companies reported 4.2% of jobs remain unfilled in Q4. And this is actually down slightly from 4.5% reported in Q3. And this is really consistent with data we get from the Bureau of Labor Statistics Job Openings and Labor Turnover Survey, the so-called JOLTS data, which you saw number of open manufacturing jobs declined from a record high of almost 1 million in April of 2022 to the current level of 428,000, a drop of over 15%. However, the number of job openings in manufacturing is almost 9% higher than it was pre-pandemic in February 2020, really pointing to an imbalance between supply and demand in the labor market, which gets to your point about the labor shortage in manufacturing. Now, one of the things I'd like to highlight here is one consequence of the shortage of skilled laborers in the manufacturing sector is an acceleration in wages. If you look at the average hourly earnings growth in manufacturing jobs, that accelerated to 4.8% year on year in January. That's up from 4.4% in December. And that's really in line with the annual growth from April 2020 to December 2024, which really highlights the fact that there's been this disconnect between labor supply and demand in the manufacturing sector for quite a while. And one other point here, according to the National Association of Manufacturers' fourth quarter outlook survey, respondents anticipate employee wages to rise 2.7% over the next 12 months, which is the same as last quarter, but you can clearly see that's a moderation from wage gains that we're seeing right now.
Right. Yeah. Two questions on that. Now, so one, you mentioned several times that, okay, there's that supply demand, and then you mentioned there's a lack of skilled labor. So my first question is, what's the driver behind that? Is it a lack of just willing workforce? Is it that what you mentioned, the wages are lacking, or the fact that they're just not properly, trained or being trained at any given level to meet that supply or meet that demand, excuse me. And then number two is you also mentioned several things that kind of look, maybe relative to the whole growth, not as great, but relative to itself and where we were pre-pandemic, things are looking a little hopeful, kind of projecting up and so forth. What would you say is the main driver behind that? Is it more just economic? Hey, we've got the times a little bit different. We're further removed from those, times of COVID and things like that? Or what's that main driver behind that kind of more bright and hopeful outlook kind of moving forward in the near future? As far as
I think it's a combination of things that you mentioned, the broader macro economy, and also some things specific to the manufacturing sector. But some of the potential solutions they could implement to overcome this skill gap include keeping up with industry changes. Obviously, the manufacturing landscape continuously evolves. And in order to remain competitive, manufacturers should ensure that team skills and knowledge are up to date, whether that's through ongoing training, compliance with industry regulations, et cetera. They also could embrace and educate on new technology. Obviously, the manufacturing industry has undergone a technological revolution. We've got automation, robotics, advanced programming. These aren't the dusty manufacturing jobs of years and years ago, but you've got these programming. They're becoming integral components of modern production processes. So manufacturers should equip their workforce with the skills needed to advance and thrive in this digital landscape. They could also offer mentorship programs. They've gained traction as a valuable tool to address the manufacturing skills gap, as they can bring in needed talent and ensure that workers enter the workforce with the necessary skills. They're equipped to perform at a high level at these jobs. And also, I guess, lastly, would be to engage diverse sources of talent. This will enable them to bridge the skills gap, requiring tapping into diverse talent pools, allowing manufacturers to access a broader range of skills and perspectives. Examples of this include veterans, vocational technical schools, minorities and women, and possibly felons who are re-entering the workforce.
Yeah, that's a good point. I like that one, last one, especially there. I mean, it's kind of like the workforce that you traditionally think, just like you think of the dusty old manufacturer. When people say, some people that aren't in the industry say manufacturing, that's what comes to mind. It's not the manufacturing of days gone by. Same thing. The workforce is not the same workforce of days gone by. So thinking of alternative and maybe, for lack of a better term, out of the box solutions to that, or where else to look. And I think that exists in many industries, but especially in manufacturing and industries like that manufacturing, where there's that, supply and demand gap, could be, helpful in helping bridge some of that. So that's interesting to hear you say that as well. So
yeah, that's a good point. These aren't, as I mentioned, these aren't your manufacturing jobs of years ago. Some of them require some technical skills, and that's certainly where manufacturers could step in and equip the potential workers with those skills necessary.
Right. Let's shift a little bit. I think you mentioned in one of the others, you mentioned a little bit about consumers, or you just hit on it briefly. Consumers drive a lot of what, the economy does, how they react, whether sometimes irrationally or rationally, but their behaviors and so forth, and how they're, reacting, how they want their goods, delivered, consumed, how they're thinking about whether it be the macro administration and how the United States is doing, or other micro, more local level responses. But how do you see consumers, as far as, where we are today, driving kind of that demand, if you will, or driving the industry kind of looking forward into, and what are manufacturers maybe doing or needing to do to kind of respond to that?
Yeah, that's an excellent point. And the good news is, one of the reasons that economic growth remains stronger than we anticipated over the last couple of years has been the consumer. Now, some of that is related to what happened with immigration over the past couple of years. How that was increasing the supply of labor, increasing productivity, et cetera. But as I mentioned, the consumer has been driving economic growth. And the good news is that's poised to continue with additional job gains, albeit at a somewhat slower pace. Still low unemployment. If you look at the unemployment rate in the month of February, it dropped to 4.4%. So that's, by most economists' definitions, that's full employment. So the labor market's still tight. Wage gains are exceeding inflation after years of lagging. So that's certainly good news. Record high household wealth, which obviously benefits upper income consumers to a greater extent, and also manageable debt levels. I say that outside of lower income households, because if you look at the level of credit card debt, a study published by the New York Federal Reserve, it's sitting at a record high. And a lot of that was due to low income households who are getting hit hard by inflation, having no choice but to turn to credit to fund some of their everyday purchases. And while I mentioned this earlier, consumers have shifted their spending to services and away from goods. We saw the opposite dynamic during the pandemic for obviously reasons. People couldn't go to restaurants, go to gyms, go to movie theaters, et cetera. So what were they spending their money on? They were spending their money on goods. That has since shifted. But the reason I mention that is because lower interest rates might encourage consumers to increase their spending on big ticket items that are often financed with credit. And I think that's certainly good news for manufacturers. Obviously, there's a lot of crosswinds there.
Right.
One of the main one being what could happen with tariffs. Several weeks ago, the Trump administration came out and slapped 25% tariffs on Mexico and Canada, special carve out for energy in Canada of 10%, and another 10% tariffs on China. Has since backed off, at least on the ones in Mexico and Canada, but that certainly has the ability to increase cost, which would, obviously that's going to impact goods and not services, since all services are local. But in terms of what some of what manufacturers could do to in response to changing consumer preferences, obviously things like product innovation. These businesses, manufacturers that are in sync with consumer preferences can develop innovative products that cater to these evolving tastes and needs by analyzing consumer feedback and market trends. They can introduce new products or even enhance existing products to be more attractive to consumers. You could look at what sourcing and supplier relationships, understanding what consumers value in products, help companies make informed decisions when selecting suppliers. Companies may prioritize suppliers that align with consumer expectations regarding quality, sustainability, or ethical practices, for example.
Right. Yeah. And you've mentioned the administration several times. Obviously, that's, everyone's mind because of the recent elections late last year, and then the new administration starting in January and so forth. And it doesn't really matter where someone feels about it. That's the administration we have for the next few years. So
that's correct.
What you mentioned the tariffs and so forth. That's a big topic everyone's talked about. What else do you see either in what's been talked about or what is actually on the foreseeable future as far as what this administration maybe is doing you could see largely impacts the manufacturing industry? So we talked about interest rates some and kind of what their thoughts are there. We talked about the tariffs a little bit. Is there anything else that manufacturers should be aware of that maybe with this administration that they have been talking about or been working on that would drastically or impact the manufacturing industry at that macro level?
Yeah, and there certainly are. And I mentioned tariffs because that's the one top of mind for most people, and also because it impacts consumers to a great extent. But there are also some policy proposals which would be beneficial to manufacturers. They've talked about incentives for domestic manufacturing, reshoring or nearshoring some of the after some of the supply chain issues that we had during the pandemic. That would give U.S. companies a competitive edge. At least those that capitalize on these incentives could reduce their operating costs, which would improve their competitiveness and lead to a surge in U.S.-based infrastructure spending. There's also the possibility of tax policy reforms. Now, the Trump administration has come out and said they intend on extending the 2017 tax cuts, but they also have talked about going beyond that, doing things like not taxing Social Security, tips for waiters, waitresses, et cetera. So some of that could lead to, and also not only at that side on the consumer side, but also on the business side, dealing with business taxes possibly being lower. That would lower taxes would increase cash flow. Also talked about maybe full expensing, which means that manufacturers would have more money to reinvest. They could reinvest that money in technology, employing some of these tax savings. That could lead to additional automation, modernized facilities, or invest in other productivity boosting innovations. There's also been a lot of discussion of regulatory reform by the Trump administration, which would lower compliance costs. And these cut costs, they could lower their costs because they're tied to meeting stringent regulations right now. There's a possibility the Trump administration would pull back on those. And finally, some trade agreements. I think it's a wild card in terms of what the Trump administration is going to do. One day he'll say something and the next day he'll backtrack on it. So it makes it very difficult to really understand what is truly going to happen. But nonetheless, there's a possibility of these trade agreements, supply chain realignment, obviously realignment of supply chains. Companies, manufacturers may need to adapt quickly to changes in trade rules, particularly if new tariffs or agreements impact cost structures. That could provide a competitive advantage for U.S. goods. Favorable trade conditions for American products can enhance that market share globally. And unfortunately, there is going to be a lot of uncertainty and disruption as the Trump administration proposes one thing one day and then backtracks on that 1 or 2 days later.
Sure.
But these potential renegotiations could introduce short-term disruptions as businesses recalibrate sourcing and distribution channels as well.
Yeah, no, that's great. Yeah, and I'm sure you get it a lot as an economist that, hey, I know I do as a CPA and one who works in manufacturing, we're kind of always looking towards the future. If I could tell you what that future is going to look like, I could make a lot of money and we could make everyone do really well. But like you said, you say one thing and then the next day it's changed a little bit, or something like COVID from several years ago happens that, you just don't see coming. That really has a profound impact. So you got to kind of roll with it. But at the same time, as we've mentioned throughout this, conversation, that, it seems like, again, it's been a tough road to get to this point, especially recovering to pre-COVID levels and so forth. And then, the supply demand issue. But it looks like, again, chipping away at it, cutting down and slowly working at these issues that has some, hope and positivity moving forward, from here. I'm sure there's a lot more that we haven't discussed that we could keep going on for easily another 30, 45 minutes. But is there anything else, we get kind of close to closing here, is there anything else that you think, hey, kind of looking forward, you'd want to know, hey, I'm a manufacturer, maybe I'm a, two warehouse, with 200 employees, that type of manufacturer, kind of working, and just trying to make ends meet, trying to grow and trying to innovate and kind of adapt to the economy that we're in, right? And the consumer behaviors that we have. What are any other final takeaways you'd maybe tell me?
Yeah, and I think just tying these threads together, I know we've talked about a lot of different topics here, touched on a lot of different topics, but I would describe the outlook as being, for manufacturers, as being cautiously optimistic. Obviously, they've been battered by high interest rates. Interest rates aren't going to decline probably as quickly as manufacturers would like to see them. Strong dollar, that could be another impact from tariffs. If the Trump administration does institute these tariffs, we could see a rise in the increase in the value of the dollar, which would obviously impact manufacturers that export negatively, I should say. And there actually has been weak overseas demand. As I hit on, the United States economy has been outperforming all of the economies around the globe. But the good news is there is some light at the end of the tunnel. As I hit on earlier, the Fed has already reduced interest rates by 100 basis points, and we anticipate another 50 basis points of easing this year, bringing the Fed funds rate down to a range of 3.75% to 4%. As a result of that, I think the manufacturing sector should expand at a modest pace over the next 2 years, with consumers well positioned to continue spending, particularly on big ticket manufacturing items, which tend to be financed with credit. So certainly lower interest rates will encourage consumers to purchase those big ticket items. And lastly, a survey conducted by the Institute for Supply Management revealed that 16 out of 18 manufacturing sectors expect revenue growth in 2025. And this really reflects widespread confidence in the sector's recovery. So certainly ending it on a good note is the way I would describe it.
Hey, for sure. Jay, I know we really appreciate your time today. If you're listening, if you've got any questions about anything we've talked about today, feel free to reach out to myself or to Jay, and we'll have to talk about a little bit more. And Jay, always appreciate, especially the positive notes that we ended on and kind of that future and that, positivity moving forward. So thank you very much for joining us today. Thank you all for listening, and stay tuned for next month on our next episode.
Thank you very much for having me. Appreciate it.
To learn more about James Moore & Company's manufacturing services, go to jmco.com. And don't forget to subscribe to our More on Manufacturing series to receive updates when new videos and podcasts are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us on our website. You can also follow us on social media for more news as the landscape on manufacturing continues to rapidly evolve.